for Auto Finance Excellence, the industry resource that shares best practices and actionable advice with auto finance professionals. Thank you so much for being a part of our webinar today. This will be our fourth and final webinar of our four-part 2014 series, presented by the Center for Auto Finance Excellence through the generous support of Fiserv. This webinar, which will last about 30 to 45 minutes and is being recorded, will explore what lenders are planning for 2015 to refine their operations using technology to improve underwriting, manage customers throughout the life cycle of the loan, and compliance management, among other things. The substance of this teleconference harkens to just some of what we do at the Center for Auto Finance Excellence. The Center was launched in 2013 by Auto Finance News and Fiserv for the benefit of the auto finance community. The Center shares its content through events like this and at autofinanceexcellence.org, which we encourage you to visit and join. Our goal is to share unique content and insights on the practice of auto finance, furthering the overall management performance of the industry. Fresh articles are added to the site all the time. Some of the most recent delve into social media risks and opportunities for hiring managers, how to prepare for regulatory exams, how to build an innovation engine in 90 days, and reining in IT costs. Please visit the site for more information and insights like this. So today we'll be discussing operations in focus, and we'll hear from a vendor and a lender about what can be done to stay competitive in today's aggressive environment. What improvements can lenders make? How can lenders fine-tune offerings and systems that support these services? And where does technology fit into the equation? As always, we encourage your questions, which can be typed into the box beside the main webinar window on your screen. The information we cover today will also provide a taste of what you'll experience at the upcoming Auto Finance Risk and Compliance Summit, which takes place May 18th and 19th at the Hilton San Diego Resort. Please note that a recording of today's webinar will be available on the Center for Auto Finance Excellence website at autofinanceexcellence.org. We encourage you to share the link to the webinar with your colleagues. And with that, let's get started. We'll have two speakers today, Scott Hendricks of Fiserv and Garen Center of Western Funding. Each will give a short presentation, which will follow up with a panel discussion. It is my pleasure to introduce our first speaker, Scott Hendricks. Scott is a product consultant at Fiserv Automotive Services, which offers end-to-end software and services that support all of indirect auto lending and leasing needs, from application through vehicle disposition. Prior to that, Scott worked as credit department manager at Wells Fargo and also spent several years underwriting auto loans and working in the mortgage space. Scott, welcome.
Thank you very much. On behalf of Fiserv, we'd like to thank everyone for their time this afternoon. We hope you find that this session is beneficial. So with that, we'll jump in. I was asked to really take a look at this from the technology side. And as Philip had said, I come out of an operations background, so I'm really not a software person by trade. But in looking at this, kind of maybe some key areas within the organization where technology can help replace or supplement some of the highly manual or labor-intensive processes that you do today. Take advantage of that from an efficiency perspective to increase your volumes, minimize your compliance risk, and give your overall operation a boost. So I'm going to focus really on four key areas: credit operations, funding operations, servicing of the accounts once they've been boarded, and then a little bit at the end about compliance and reporting. As we take a look at credit operations, none of these should really be anything that isn't something you've at least seen or discussed within the organizations. And really, these are some fundamental lifts that are going to give you the ability to increase your auto decisioning process, which obviously gives your analyst time to focus on the 20% of the deals instead of the 80% that are clear ups and downs. From a custom scoring perspective, there's really two ways to look at that. One of them is that over the last 25 or 30 years, since scoring has really become much more prevalent within the consumer lending space, We're seeing a lot more ways now with better data aggregation to be able to slice and dice those bureau components. That bureau aggregation gives us a much better look at what the overall credit risk of the customer is. And there's a number of tools out there on the market today that can be accessed either through third-party integrations or that you can, buy custom scorecards or buy, variable definitions and code those within your system. So that ability to that more granular and enhanced credit data really gives you a lift on the custom scoring side. As we look at that, one of the primary things that the risk guys are always worried about is how do we migrate from an existing set of scorecards or policy, business logic, decision methodologies, how do we migrate that over to a new one? One of the things that we're seeing a lot of out there is this concept of champion challenger. So the ability to take your champion cards, which are the ones that are in existence today that you have documented performance metrics on, how do those play against ones that are proposals maybe for future use, which would really be your challenger cards. There's a number of ways to accomplish that. If you can't do it within your current platform, you have the ability to integrate with outside decision engines that can do that and so forth. Kind of as really an extension of the scoring process is really where your business rules engines come in. And again, those are things that you can either build on your own, build the simple logic into the systems, or they're outside capability for that. But really what that's doing is taking the kind of the analyst thought process and translating that into business rules within the system. So things where clearly you're going to auto decline a customer based on score, but there are filters maybe that you want to look at for an existing customer of yours, even though they're below your score cutoff. You may still want to review that on an exception basis. They qualify for an auto approval, but their debt ratio is too high, that kind of thing. Being able to apply business logic to straight score up and down, so that you're really, again, pulling those things out of the auto decision buckets and putting them back in front of an analyst for those deals that really require a more subjective approach to the decisioning process. So taking that custom scoring and the business rules logic and really applying them together gets you into a much more refined auto decisioning process. Where you're taking the combination of that score-based kind of initial recommendation and then combining that with the business logic to vet whether that initial score-based decision makes sense or not to you organizationally. Natural extension of that is we can look at pricing. With the margins as thin as they are today, that ability to maintain efficient and accurate pricing is becoming much more critical to maintaining profitability. So as those pricing models are evolving and becoming more sophisticated, really the ability to extend that within your originations platform, so that the analysts aren't having to look up, go into spreadsheets or printouts on the wall to try to figure out what the rates are for a particular customer based on credit tier, quality of the asset, advances, terms, all those things that we tend to take into consideration when we look at a pricing model. To be able to automate that and give you the advanced ability to get more granular is a huge benefit, from the margin perspective. Then a little bit from an integration perspective, and what I try to do is give you kind of the operational aspect of it and what you can do from an integration perspective if those particular features aren't available to your current originations platform. A big one of those is going to be this concept of external decision engines or the bureau aggregator part. So I talked about, the advancement of how we look at bureau characteristics and calculate those attributes. There are a number of products on the market that are available for, in real-time web service type fashion, where you can reach out and they will return back to you a set of variables that you can use within your own system, to do your scoring or your decision logic. As well as coupling that with an external decision engine that can actually do all of the scoring and all the decision logic and recreate all of the business rules that you would want to do. Have all of that executed in an outside package, and then have that ultimately that decision and potentially even the pricing tiers and those things returned back to your origination system for the decision. So a lot of this is really the technology capability, and the other part of it really is what your capacity is from a resource perspective. Do you have the skill sets of the individuals within your organization to be able to do that? do the logic of creating new scorecards or looking at how to recalculate attributes. So do you, A, have the overhead to be able to absorb those resources, and B, do they have the skill sets to be able to perform those types of activities? If they don't, then that obviously lends itself to a more, looking at the external decision engines and models. As we look at other opportunities from an integration perspective that can help give you a lift on the credit operations side, a big thing now are the alternative credit data sources. So we're all familiar with TransUnion, Equifax, Experian, as well as Dun & Bradstreet and Equifax and Experian on the business side for credit bureaus. But there's a number of customers that kind of fall through the cracks on that. You don't have access to robust bureau data or payment history data on those particular customers just because of where they fall within the market. Most of the major credit bureaus, as well as some of the outside vendors, have products now that are really tailored to that market, and that will give you a more rounded view of some of these thinner traditional credit file customers. And obviously, as we all know, more credit data is key when we're trying to look at accurate risk assessment and accurate pricing. So getting access to those services can be a big lift when you get into the, especially in the non-prime, down near and subprime spaces. Some of the other things we're seeing a lot of now are really on the employment verification side. Obviously, STIPs tend to be a big stumbling block with dealers. They don't like to provide them. It can cause issues on the funding side because now we're chasing things before we can fund contracts, which obviously keeps things in the pipeline that we don't want to do. So the ability to do a lot of that verification up front as part of the credit decision process, that negates a lot of that issue that you have on the back end. And there's a number of services out there today that can give you either access through the IRS to tax return information or through the payroll systems to give you payroll information that you can validate, at least employment times and, in some cases, income through those services. Keep in mind on some of those, a lot of these external sources are going to be permissible purpose. So if you are accessing those as part of the credit decision process, there may be implications of that for adverse action. So you need to make sure that you have the ability to absorb that into your current adverse action process and be able to disclose to the customers that those particular data sources were accessed as part of that decision. So, we're seeing kind of a rise here in the non-prime, subprime markets as a, volume relative to the overall lending population. So as that market segment continues to increase, the abilities to get to that alternative data and those employment verification services could be a huge lift to you, operationally as well as from a risk management perspective. All right, the next two are kind of basic, but a lot of times when we're looking at existing customers, a CIF interface to be able to go back into our servicing system and at least pull, some level of data that tells us as part of the originations process that the customer has a relationship with you as a lender, and B, what type of relationship is that? If you pull the CIF back and the customer has 2 repos with you already, in the last 12 months, are you going to be inclined to give them another loan? So access to that CIF data, even though the rest of the credit profile or the structure of the deal might be okay, access to that CIF could be a nice filter to be able to say, hey, look, normally we would auto-decline, but because of this relationship, we'll take a look at it on a subjective basis, or the other way, unfortunately has poor performance with us. Even though we might be a viable deal, we're going to pass because we don't want to take that risk again. Building that into your auto decisioning process can help substantially decrease the number of deals you have to look at, or the other side of it too, to make sure that you're trying to retain those customers that even though they don't typically fit your credit profile, they do have a positive relationship. From a CRM standpoint, as a solution provider, we're really seeing a lot more requests for this. As you have field staff that are out visiting dealerships on a daily basis, the one thing that they always are yearning for is having better and more up-to-date information so that they can better manage that dealer relationship. So, by integrating your credit and or funding operations with your CRM tool, you're making that data readily available to the salesperson, either on an aggregate basis or even at the individual contract status level, for example. so that they're able to address that dealership or any of those issues while they're in that dealership as part of that dealer service call. So it gives a better customer service relationship with the dealer, and it makes sure ASMs and regional managers more effective in what they're doing on a daily basis. And then the other aspect from an integration perspective, Dealer Track and Route 1 and ODE, which is Open Dealer Exchange, are kind of really the three big players today in kind of the general indirect market. But they all offer a number of services and integration opportunities through those portals that can give you, very close integration with the dealer desktop. So as we look at this from a credit perspective, we have a dealer that every time he changes the car, he needs to submit a new app. That's more applications you have to process, more credit bureaus you have to pull, more people that have to review. Being able to enable those dealer chat features or giving the dealer the ability to update an application that he's previously submitted and resubmit it, that can significantly cut down on your bureau expense and on your operational grind. As well as extending what data you're sending back so that the dealer has more information that's more appropriate. It helps him to do that job better so that it cuts down on the rehashes and hopefully cuts down on the number of deals that you're losing because other people may be providing that information. So that's it from a credit perspective. We'll jump into funding here. So when we look at funding, a lot of it's really the same as credit. Funding tends to be, from a process perspective, tends to be much more black and white than what we see in credit. So, does he pass this particular edit or not? And if he doesn't, who's responsible for making the decision whether you're going to buy the deal or bounce it back to the dealer to be either recontracted or hung somewhere else? So when we look at funding, really a couple of kind of big things jump out. It's very data entry intensive. We have to enter all that contract data into the system so that we can go through and do the validation process. The ability to digitize that, either internally, either centralizing it so that you have one dedicated data entry group that does all of the data entry, freeing up your funders to focus just on the edits and on the validation, or potentially outsourcing that. And again, there are there's several well-known vendors out there that provide that as a service. The other aspect of it is, if you go into a manual funding shop, we have files everywhere. And obviously that takes time. We've got to move them around. They have to be broken apart. So there's labor and work there, not to mention, potential of losing a file. So if we can take that process and scan those images in and make the images available to the funders through the platform, they're readily available as soon as they're scanned in. We don't need to worry about them being lost. They're always available at the time that the person's reviewing the contract package so that it's a much more seamless process to the funder. And if you can integrate the two systems together, that's even better, so that the funding system has the images appended to it so they can just click the image to view it instead of working in a separate imaging system. There are some constraints on that depending on the type of originations platform you have and the type of imaging system you have. So whether or not you can couple those really is going to be based on whatever the technology is you have currently in place. When we look at it from a business rules perspective, it's similar aspect to what I talked about from a credit standpoint. Again, with funding, we're looking at does it pass the compliance edits? If it's is it above usury? Does it meet Reg Z? That's part of it, and those things tend to be fairly straightforward. Does he have the pay stub that we requested? But when you look at the ability to tie that funding deal back and look at how we improved it in credit, being able to do those kind of preliminary edits that people tend to have to do manually today. We approved him at a $400 payment. It came in at $408. Is that within the 5% or $10 margin that we allow, or does it need to go back to credit? Those types of comparisons to the way the deal was approved versus the way it came in for funding. Being able to automate those edits makes it much easier for the funders to get through those packages, as well as giving them some kind of an indication, is this something that's a credit exception or is this something that stays on the funding side of the house that can be resolved by funding manager or so forth. So, and it's not only the comparisons back to the credit decision, we're also looking at things like the payment went up, and this loan wasn't paid off, is he still within the debt ratio guidelines? And if not, how do we handle that? So being able to automate a lot of that process really will streamline your funding operation. The other thing is that really the document tracking and the checklist process. Funders having to go through a package and decide whether it needs, a notice to cosigner, or does it need this, arbitration form because of the state that it's in. There's a lot of training involved in that. There's a lot of experience involved in that. People tend to have things tacked up all over their walls by state, by credit tier, by product type. What things do we actually need to collect, physically in the form of documents versus what things do we need to check, in the form of checklist items. Being able to automate that process so that the user doesn't need to go through that thought process, it significantly reduces your training time and your training cost, because you're basically having the system be able to present that to the funder. They still need to know what they're looking at. They still need to be trained to understand that whatever is in front of them is acceptable or not, but that decision process that somebody normally has to go through to decide whether they actually need it, even cutting that out so that the system can present that to them is a huge lift. And much like on the credit side, when we look at how we communicate with our dealers today, how can we extend that process to A, make it more meaningful to the dealer, and B, more efficient to you as a lending operation? So how do we disseminate contract issues to the dealer? Can we automate that so that we generate a notice to the dealer back through Route 1 Dealer Track ODE? Can we tell the dealer in that response, here are the issues we have, the contract's missing the dealer signature, the assignment's incorrect. Being able to automate that back to the dealer, giving him meaningful information with what he needs to fix is a huge benefit, because you're not on the phone, you're not waiting for callbacks, you're not having to send somebody into the dealership, you're not wasting the money on the faxes. That integration has a number of savings points in it. The other thing is the ability to automate your customer correction letters. Today, that in a lot of organizations, that's very manual. If somebody has to type in the VIN that was on the contract versus the actual VIN of the vehicle, type those values in. Being able to automate that letter and pull those values from your funding system into the letter to send to the customer. Again, it's a substantial time savings if you're doing a lot of those. From an integration perspective, topic that's near and dear to my heart is e-contracting. When we look at funding process overall, there are very few things in the last 15, 20 years that I've been in this business that has had more of a substantial lift, both operationally as well as from an error management perspective, as e-contracting. E-contracting, in its ideal state, you're getting the digitally signed documents that are based on the data that you're validating within the system. You don't need to review documents. You don't need to look for them. The portal's handling, making sure that all the correct things are there and signed. You're just validating that the edit, all the data passes your edits, and those deals can, theoretically be auto-booked, depending on the sophistication of your system. It doesn't have to be full-blown e-contracting. Even if you're able to just get the data set to be able to do some preliminary validation back to the dealer to say, hey, send me the contract data. These things are going to be an issue. These are errors that you have to fix. Here are some other things that might be a problem, but if we can look at them on an exception basis, but just know that these might be an issue. That process is going to have a significant lift if you're able to do it. Not only to your operational expense, you need fewer people to fund the same number of deals. You have a better dealer service level because you're not bouncing deals. You're telling him up front that there are errors with the deal that he needs to fix. That's going to shorten your funding times because now you're focused on deals that need to be reviewed versus every deal that comes in the door. And theoretically, if the dealer is still using the validation process and correcting things, you're going to have fewer deals on that contract in transit list, which cuts down your funding times. Other options in there are on digital channels, and I talked a little bit about this earlier, but the ability to just get the document images, I'm supposed to have to pass the paper around, and then the data files. From a communication perspective, both the portals tend to have fairly robust contract status mechanisms. So, building those out to be able to send back those errors and give the dealer more meaningful information around what's going on deals in-house. that's a huge lift, both from a timing perspective as well as a dealer service issue. And again, the idea of being able to extend that information out to your field staff through your CRM utility, so that they're able, as they're making their normal dealer visits, they can address any contract issues and collect STIPs or try to get things redone while they're there. So don't look, if you can, that's a great thing to take advantage of. When we look at servicing, and again, now that we've gone through the credit and funding process, we have a customer that's on the books. How can we really make that process more efficient? And a couple things that really jump out from a business intelligence perspective. We're seeing more and more of this. We look at things, behavioral scoring, and being able to evaluate when we need to, start collection activity on a particular customer. When do we need to be worried about a customer, prepaying a loan, try to, manage our runoff. So being able to look at that portfolio and run that against scorecards or behavioral profiles to try to identify, when we can be more efficient in those operations is a huge help. If you have a customer that pays on the 25th day late every single month, there's no need to call them at 10 days and tie that up in your dialer and your collectors. You make the call on the 24th and you get your money. So being able to recognize those types of customer behaviors and being able to build that into your strategies is a huge benefit. From a leasing standpoint, the jurisdictions and the tax rates change constantly. So having that process automated so that you're not having to go through and maintain, all of that, all those tax files, that you're remitting the correct amounts, a huge benefit if you're able to do that. Lots been talked about recently with millennials and their kind of a need to self-serve. They're on their iPad at 2 o'clock in the morning making their payment. Extending, the types of routine things that we do on accounts all day long that requires a customer calling in or sending a letter, and somebody having to, log into your servicing system and make that particular change. Being able to extend those activities so that the customer can manage that themselves. They moved and they, didn't get their last statements. They want to go in and do an address update and get a copy of their statement. To be able to do that online, saves you from having a customer service rep take the call, print the statement, fax it or mail it, whatever that is. As well as some of the basic things that customers need to do. If you're always going to grant a one-time due date change within 15 days, if you're able to extend that capability out through your customer care website, they can make that change on their own without having to require you to do that. And again, when we look at the dealer portal aspect of this, Dealer Track and Route 1, the ability for dealers to interact with your customers from a service standpoint. Maybe it's end-of-term telemarketing opportunities for your off-lease vehicles, payoff quotes, things like that, where you can integrate servicing through the portal to the dealer. That can give you efficiency gains there as well. There's the other benefit, the other opportunity, as with data entry and some of that funding process, the ability to outsource some of your back office activity. We're seeing more and more of that. There's a significant amount of overhead to fully staffing a servicing operation, especially if you're a lender that's in startup mode, to have a fully staffed collections and recovery department, because you may have an account that goes delinquent in the first month. You're carrying all of that staff, whether you need them or not, right out of the gate. As well as portfolios ebb and flow, and lease portfolios ebb and flow. Maintaining that staffing level may not always be the best decision financially or operationally. So there are benefits to going outside, going to an outsourced operation to handle some of that for you. What it allows you to do is really focus on those aspects of the operation that you need to manage in order to make your business model work and get the margins that you're expecting to get. But at the same time, things that are heavy facilities costs or overhead costs from a personnel perspective, you can minimize that by offloading some of those routine functions that you don't need to maintain or don't want to have the overhead to do it. If you go that route, there's just a couple things that you should keep in mind. If you can find a vendor that will do kind of an a la carte service menu, if you will, It gives you more flexibility, especially if they're able to do things, within the lifetime of the service contract. If you need more people at certain times and less at others, if you can find an outsourced operation that's willing to work with you on those things, that's a big benefit because you're paying for what you need, as opposed to having kind of that constant staffing level that doesn't always make sense. And the other thing is, if you do go the outsource route, a lot has been made recently about vendor management. The lender is responsible for the activities of any of these partners that they outsource activity to. So it does require that you have a fairly stringent and well-executed vendor management process. Not only from a policies and procedures perspective, but also you need to make sure that you're doing your due diligence up front as part of the vendor selection and contract process, and then there's ongoing vendor audits that you're going to have to continually do to make sure that that vendor is in compliance with all the state and federal regulations that they need to be, so that you're not liable for anything that they do that's not within the confines of what they're allowed to do. I'm going to kind of blow through this one pretty quickly. I think compliance is something that we've all, near and dear to everybody's heart, but the laws are the laws, and really, if you don't have those edits built into the system, requiring people to have to do Reg Z calculations and run tapes and do some of those things that on a manual basis, obviously there's always an opportunity for error there, as well as it can be very labor intensive, but wherever possible, automating all of that so that that within this state I need an arbitration agreement. I know that within this state I'm within the usury limit, whether it's a rate cap or or dock stamp fees in Florida, that kind of thing. So that ability to automate that process so that you're not relying on individuals to do that. The other big thing is maintaining effective audit controls at all the levels that you're that you need to. So user activity, when they're using it, logging into the system, and what types of activities they're performing, as well as governing and tracking any exceptions to policy that users are overriding, or if they're making data changes to get around edits in the system, those kinds of things. You need to have fairly strong monitoring tools built in to be able to capture all that information and then act on it if necessary. When we look at some of the kind of the other compliance things relative to identity and so forth, there's a number of integrations available out there, both through the credit bureaus as well as some kind of independent third parties. So your identity verification, red flag laws, OFAC, those are obviously two big ones that you can do either through the bureau or through LexisNexis or some of the other various standalone vendors. The other opportunities there too around address validation and formatting. Is this an apartment building and it needs an apartment number, which you don't have within the address record. So being able to recognize valid addresses, or if there's pieces missing, that's going to significantly help you going forward if you have to do skip tracing, because now you know that at least it was a valid address at the time the deal was booked. You're not waiting for that welcome letter to come back to know that you've got a vehicle out there and you don't know where it is. And then the last thing is really around the GEO code lookups. So really when you're leasing portfolio, again, this goes hand in hand with the jurisdictions and the taxing rates, being able to automate that GEO code assignment so that you're making sure that that dealer and or customer are in the correct GEO codes and you're getting the right taxing information. Reporting, a couple things around this. There's a lot, big buzzword now is big data. But really what that means is getting greater availability to my data and better visibility into what it means. Availability perspective, a lot of these big traditional data warehouses, you're getting a nightly feed or a monthly report or that kind of thing, and they tend to be very, very slow to react if you need new data or new queries run. They're not always agreeable to that type of activity. So when you look at your reporting structure and what your reporting needs are, focusing on things like getting faster access to more data and being able to make changes to what data I need when I need it on a relatively quick basis is a huge benefit there. And then once you have access to that data, how do I use it? So when we look at kind of the traditional standardized static report, what's my month-to-date activity report? What's my what's my operational overhead expense. Those kinds of things tend to be very standard, static. They don't change a whole lot. And that's fine for a given purpose, but it doesn't tend to give you where am I in the here and now. Building more dashboards in so that you can get real-time looks into where you are, a current operational aspect. They tend to be very visible, gives you a much better look at your data. Then when you look at ad hoc reporting, I want to go in right now and see how many deals I have that are, above this term and this credit tier and this score and then so forth. There's some concerns around that when you look at it from a system security and a data management standpoint. So having the ability to build a facility that allows you to do that type of ad hoc reporting can be a big benefit, but there are some operational and technology concerns there that you need to work through before you get down that road. So that's all I had on a prepared basis. So I will turn it back over to you, Philip.
Thanks, Scott. Great stuff. I would remind everyone that you can ask questions, submit comments at the left of your screen. We've already gotten a couple questions for Scott, which we're going to get to after we hear from Garen. So now I'd like to introduce Garen Center. Garen is the president of Western Funding, located in Las Vegas. Western Funding's loan programs for used vehicles are geared toward the subprime borrower unable to access traditional lending credit because of the age of the vehicle being financed or the customer's employment and credit history. Garen assumed the role of president of Western Funding in January, so he has just about a year under his belt. He's been with Western Funding since 2011. Garen, welcome.
Thank you so much. Can you guys hear me okay today?
Sounds good to me.
Okay, perfect. Thanks so much, Phil. I appreciate it. So I think what I'll do, guys, is I'll take a little bit different approach, and I do appreciate the presentation that Scott put together. I'll tell you for a few minutes a little bit about the history of Western Funding and how, through my conversations with Phil, we thought it would make sense to include us as part of somebody who's, currently growing, coming out of a unique situation in Western Funding's past, how we're accomplishing our growth objectives, and some of the things that we're facing. And we thought we would be happy to share some of those concepts with you guys. So Western Funding's been around 50 years, but it's actually more like a startup at this point. In January of 2014, it was acquired by Westlake. Westlake was really searching for a participation-based lender, a lender who would be advancing a portion of proceeds to the dealer at funding, and then based on performance in the future, the dealer would have the ability to receive future payments down the road, similar to something that Credit Acceptance and Go Financial do. And so because of that, they thought Western Funding would be a great place to look at. And so they acquired them in the beginning of the year. The company had about $30 million in loans, so fairly small. The portfolio has grown to about $50 million through this year, so we're up almost 100%, maybe close to $60 million. And the expectation is that we'll be growing to about $200 million in outstandings by the end of next year. So maybe a fourfold or so growth there. And it's obviously a heavy focus on making sure that the paper performers are not just putting on production for production's sake. And so the reason that we thought it would be interesting is because we face some of the challenges, many of the challenges that both experienced lenders and kind of de novo startups face. Although the portfolio was small at only $30 million, we had some infrastructure from when the portfolio was much larger. And we had to put a lot of infrastructure in place to really get back to business and funding loans. And so with that, we anticipate that next year we'll fall under the large participant rule with one of those 30 or so lenders purchasing at least 10,000 contracts next year. And so that will bring a different level of scrutiny that we have been able to avoid this year as we got production rolling again. Culturally for us here, we have a very open environment. Everybody sits out on the floor. We don't really have any offices except HR and accounting. It's kind of a very free-flowing and free concept environment. Myself, I sit on the floor, and we think that that's been helpful for us and able to react very quickly to the environment and things that happen throughout the day, as opposed to even putting seats closer together to keep that communication flow going. A little bit about our dealer base. Historically, Western Funding's financed older vehicles, shorter terms, more miles, over 100,000 miles. Weighted average term originally was maybe 3 years or so. Weighted average vehicle age was probably 2008. And we've recognized that as the Western funding evolves and grows, we think it makes more sense to take a harder look at some of the newer vehicles. And so the programs that we're putting out now are definitely a lot more competitive with newer cars, sub 100,000 miles. And we think that when those cars go to auction, based on our heavy focus on LTV and advanced to loan metrics, we think that we're going to perform a little better than on the older vehicles, especially in the next 18 months, as we anticipate there's going to be a pretty heavy influx of vehicles at the auction. Obviously, like a lot of lenders out there, we're definitely seeing a lot of competition. I'm happy to share some of our numbers. In the beginning of the year, we were probably funding, less than 100 point of sale deals a month. We've reworked our program a handful of times, put out over 300 point of sale deals last month. We'll do 600 this month and probably 1,200 in a few months from now. And then in addition to that, we also have a fairly prominent bulk or seasoned portfolio business for which we'll buy seasoned paper for the borrowers made some number of payments. So maybe for the first part of the year, we were a little heavier focused on bulk as we built the infrastructure for the point of sale, and now we're really looking at the point of sale. What we're seeing right now as far as performance goes, we are seeing a slight softening in the bulk market, both in performance and pricing. We felt it was pretty heavy throughout the year. The bids were very, very competitive through some of the very well-known players buying seasoned paper, and we think that we're starting to see a little bit of softening on that in the last 30 days. Fewer competitors and prices coming down just a little bit. With the point of sale, however, we're still seeing very, very aggressive pricing on our competitors. Our advances are anywhere from 60 to 93 cents. My weighted average advance on the print of a note is about 80 cents. We put the remainder between the advance and the print in a reserve pool. And if the paper performs, the dealer has a chance to earn that in the future. Our advances have stayed fairly flat this year at about 80 cents. But with that, we have definitely seen LTVs increase a bit, and we've also strengthened the down payment requirement. That's probably one of the things that makes us a little different than some of the other guys out there. As we continue to see erosion maybe in the seasoned paper, we'll probably continue to adjust our pricing, making sure that we're earning our required yield on the deals. We're also seeing a fairly, healthy erosion and competition in some of the credit guidelines. So we think that if we can kind of stay the course, the fact that Western funding wasn't really originating in the second part of 2013 helped us avoid some of those pitfalls that we saw in the credit guidelines. And we think if we stay the course for the deals that make sense to us, that we should actually come out pretty well. But with that, it is still very competitive. And, I think that attending the last couple of conferences, I had a chance to talk to another number of other finance chiefs, and you constantly hear the same thing. You hear people say, oh, we don't do those deals, we don't do these deals or those deals, but kind of privately you tend to hear that, when you're looking at bids from competitors, there's definitely a lot of stretching in the credit guidelines, and we're hoping that with a slight increase in interest rates, that might flush out some of the competitors and get pricing back to kind of more normalized levels. As far as internally in operations go, we've had a lot of conversation this year on really what I would call build it versus buying it. Westlake is a very heavily focused technology company. We have a very strong focus on technology and data as well. It was really great to hear a lot of points that Scott made. One of the things I touch on for us is one of the biggest implementations we made this year, really the two biggest ones. Number one was Salesforce, and the second one was an automated decisioning engine. For us, Salesforce has allowed us to really create a tool for which we can communicate all aspects from decisioning, funding, clearing sticks, working with a dealer CRM, reporting, all real time with frankly pretty cool dashboards. So we have a bunch of TVs around the office that are constantly tied into the database, and throughout the day we can know how many deals we've funded, how many decisions we've issued, by which sales rep, credit metrics, LTVs, trends in the performance of the actual funding process, time to funding, and we've really put a very, very heavy focus on that. We felt that in that case for us, something like Salesforce was already built, and it's anything that a pretty good code writer can snap on their technology piece and get it to work for your business. And so for that, we decided let's buy that one. On the other hand, for automated decisioning engine, we actually acquired a tool through Dealer Center, which is owned by Nowcom, which is owned by Westlake. And so for Dealer Center, we now put a decision out in 15 seconds. So it used to take us maybe 17 minutes for a person to manually decision a deal. They would punch all the borrower's information, the collateral information, the dealer information into a spreadsheet. It would spit out a customer score and then a decision. But one of the things that changed is as the company's grown through the year, we were maybe decisioning 1,000 deals a month in March, and this month we'll decision over 6,000 deals. It was pretty obvious that for us, not being able to put out an automatic decision was definitely a negative in our ability to service our dealers. So for us, we take a number of different things and putting the decision together. So we're obviously focused on the collateral, we're focused on the dealer, and we're focused on the borrower. And we found that those three together, when we put them in our custom scoring algorithm, we tend to have a pretty good indication based on the history of Westlake and the history of Western Funding on the borrower's both likeliness and willingness to pay. And so that's been something important for us as we look at that different credit criteria to try to figure out which types of borrowers are going to pay and which ones won't. We've also been able to do some digging around email addresses and find run an algorithm that said which types of email addresses borrowers may pay or may not pay, and incorporate some of that into the algorithm as well. So there's a number of metrics that we use to try to figure out if we think that borrower is going to pay. We use tiering as well. We tier our dealers based on historical performance, first payment defaults, compliance, kind of everything that would go into how you would consider a dealer. We found that the same car with the same borrower score at two different dealers tends to perform differently. We do, extensive static loss analysis on both the car, the borrower, and the dealer, and then would price accordingly. And we found that the heavier that we look at the analytics side of it, the better performance of the portfolio in total. The next process for us is probably automation of the funding process. So as I said, we're still growing. We have big expectations that are expected of us by our parent company and of ourselves. But it's funny when you really come out of the gate doing almost no deals in January, and you're doing 1,000 deals or 600 deals 12 months later. It's definitely the growing pains that come with that. Things that when the company was larger, we took for granted, and that infrastructure existed. And today, it's things that we're actually rebuilding again. So it's fun. It's very entrepreneurial here. It's probably faster paced than most places I think our staff's worked. But we tend to find that we're pretty excited with what's ahead. So with that, those were really the primary things I wanted to talk about, production and kind of the technology side with what we're doing. And I think with that, I'll hand it over back to Philip about anything else you guys would like to talk about. Oh, wait, one last thing. On compliance, we are using third-party print packs with Dealer Center. And so we've given the dealer the ability to print all the docs and everything directly out of Dealer Center. And so that's helping with some of the compliance. So we're not constantly shipping deals back that don't match the decision. So when we put the decision out to the dealer, the deal that shows up matches the decision that was issued. We frequently have, those decisions you have to make whether or not you're going to honor the contract that showed up if the variance is beyond X% from what you've approved, both either the amount financed or the borrower's payment. So I did want to kind of drop that one in. And so with that, I'll open up to any questions and hand it back to Phil.
Thanks, Garen. Appreciate it. So we do have time for at least a couple questions. And Garen, you mentioned the buy versus build decision. What's your toughest, or which buy versus build decision is looming for you in 2015? Do you know yet?
Sure. I mean, it's definitely automation within funding. You're doing 300 deals in a point of sale basis. We can buy 1,000 in a bulk, but 300 on a point of sale doesn't sound like much. You're only talking about funding, 75 a week. I mean, it's not that many deals, but if we go to 2,000 deals a month, trying to automate the funding process, deciding whether we're going to have our contract shipped to a centralized location or whether we're going to continue to manually review deals here, that's probably the biggest one that I anticipate we're going to feel is automation of pieces of funding and verification.
Sure. Scott, what area of operations from Fiserv's perspective seems most ripe for change, and why would that be?
I think as the volume of the non-prime stuff is going up, I think we're seeing a lot of a lot more pressure on the non-traditional data source type things. So for us, a lot of our effort is really around integrating with with some of these best-in-class services and providing that to our client base. A lot of these services are available kind of standalone on the internet. So it's not they have access to them from that perspective, but being able to automate that integration and bring that data in so that they can build that into their workflows and their decision logic and make that data available for automation is a huge effort on our part. And just really the overall kind of efficiency of the lending process. How do we anything that we build today, we're really looking at how can we do this using business intelligence and if not making the decision systemically, how do we provide better cues and guides to the user so that they're able to spend their time on the things that are meaningful and not having to worry about the the mundane things that we can really do pretty effectively in an automated environment.
Sure. And one of our submitted questions, Scott, do you see the volume of thin file credits decreasing with the decline in unemployment? And if not, do you expect more resources allocated to thin file industry-wide?
I think a lot of the thin file to me is really, the millennials coming up now that, they were spending money on things other than cars and houses. We're seeing kind of a fundamental shift in, in that kind of hierarchy of need where, when I first started in this business 20-some years ago, the mortgage was the thing that everybody paid first, and we're seeing now that it's the car that's getting paid first. But a lot of these millennials now that don't have any of that type of credit, they're really falling into that thin file area. So you're going to see more and more customers in their late 20s, early 30s that don't, they're driving around in a 10-year-old used car that mom and dad gave them or co-signed for them. That loan's dropped off the file. They have credit card debt, but that's about it. So I think as that buying power of that group starts to expand, I think we're going to see more of that need for some of that non-traditional credit data, as well as now that we're kind of on the back end of the the Great Recession here. I think we're going to start seeing more people with impaired credit. They had kind of a lull in there, and now they're coming back to the cars that they have that are older that they kept through maybe a bankruptcy or a term in unemployment. As they're re-entering that market for new vehicles, I think we're going to start to see some of them kind of fall into that thin file type of bracket.
Right. Garen, you mentioned before the weighting in your custom scoring model. What are you prioritizing in terms of your custom scoring, and what are you thinking of changing?
Sure. I appreciate that. Western Funding historically has had a much heavier focus on the borrower. Westlake, our parent company, I think has always had a heavier focus on the collateral. And for us, what we're tending to see and what we like to focus on is the guy going to pay? And so for us, we're very, very borrower focused, probably more so than LTV or advanced to value focused. I think that in next year, we're going to continue that focus. It's not just has the person had a repo? It's the repo frequency. It's the time since the repo. It's the other things that we can bring in to consider whether or not we think that contract's going to perform. That being said, there are a lot of cars out on the street now that, through the lack of inventory that occurred in 08 and 09, we expect there to be an extensive amount of cars coming through the lanes next year that's going to deplete the pricing as cars roll through the auction. And so for us, it's really about probably the borrower first, secondarily the collateral, and then the third piece that can flip the deal either direction is always the dealer. You have the same car, the same borrower, two different dealers, just performs very differently. So with that, I'd put our borrowers our primary focus.
Yeah, and if I can add something to that as well, I mean, I think we're seeing more requests and more kind of ability. Is there an ability to build a dealer scorecard, if you will, into that decision matrix? You touched on that earlier, that's really a critical part of the indirect model. That traditionally that's not been part of credit scoring or of automated decisioning, and access to that data now that's becoming more readily available. I think we're going to start to see some of that getting built into the decision logic.
Great. And final question. Sorry, go ahead. Did you have something to add, Garen?
Oh, no comment. No, I just said I'd agree.
Oh, okay. Scott, what have your clients assigned as top tech initiatives for 2015?
Again, I think it's really, for us, it's integration out to some of these third-party services. We're, from a capability and a deliverable perspective, our system's at this point pretty complete. So a lot of the access to this data and being able to, on the other side, make that data available to to the CRMs and to the data warehouses, so that they can, or the data reporting facilities, so that the lenders have visibility to what they're doing from from a management perspective, but also being able to give them more access to that information up front as part of the decision process. The kind of the traditional indirect model has been tell me in credit and show me in funding, and I think risk models the way they are, the more of the show me in funding getting moved into credit and showing me in credit before I make the decision. I think we're getting some pressure there that's becoming much more of a need. The short answer is integrating to third-party services, but for those reasons.
All right, thank you, Scott. So I think we have to wrap it up now. Thank you, Garen. Thank you, Scott. Center for Auto Finance Excellence, with the support of our partner Fiserv, is committed to bringing you quality content on best practices and auto lending and leasing, and we hope you'll join the center at autofinanceexcellence.org to receive our alerts and participate in other center events. There will be a recording of this webinar on the center's website shortly. Please be sure to keep an eye out for additional events from the Center for Auto Finance Excellence, and thank you once again to our partner Fiserv for their support. This concludes today's teleconference. Thank you again to our speakers, and thank you for attending. Have a wonderful day and a happy holiday season.